Holy smokes, you won't believe what the Federal Reserve just said and forecast about when inflation's going to go back to 2%, what the lagged effects are going to be, where the most pain is going to be, and how that could lead to a recession, and more. This is a good piece, and there's a lot to talk about on this one, and we'll also talk about certain stocks and valuations. So buckle up, this is a deep one. Let's go! And this video is brought to you by StreamYard, because I recorded it with StreamYard. Go to meetkevin.com/StreamYard to learn more about how you could record live, edit and cut and post later. Amazing recording studio, great for almost anything you do with video in your office. Check out StreamYard, go to metkevin.com/StreamYard or meetkevin.com/StreamYard. Yes, I already finished this cup of coffee for the haters who are like, oh my god, this cup of coffee's empty. But it's branded, okay? I generally make 2 cups of coffee because when I finish one, I don't want to get up to get the other one. And then I actually had my son refill this one, so this is actually a 3rd cup of coffee. Anyway, point is, yes, I'm flailing this one around because it's empty, but it's branded, okay? Sponsored! Hashtag paid promotion! Welcome to the Chicago Fed. The Chicago Fed just released this particular letter right here, and they talk about the past and future effects of recent monetary policy tightening. And what's really fascinating about this is, well, mostly we're not going to read all of it because, well, there's a little too much econ in this one, and as much as I love econ, let's just say there's a limit. So we're going to start with a little abstract, and then we're going to go to the conclusion, and then we'll look at a few charts, okay? So let's start here, and the conclusion's actually pretty wild. Now, it's not to say that Jay Powell's going to listen to this 100%, but let's think about it a little bit because there's some big things that they say about inflation here. So, we estimate how much of the impact from the Fed's current tightening cycle is yet to be felt in the economy, in both absolute and relative terms. To do this, we use some fancy models, which they explain the models later, but basically they use some fancy stuff. And they estimate that the majority of the effects of output and inflation, or on output and inflation, that higher interest rates have had, in other words, the lag, they suggest, which, keep in mind, the bears are telling us that because of the lagged effects of the Fed's hiking policy, we're screwed. Like, it's going to take 18 months for you to feel all of the effects. Maybe. Some say that because of the clearer communication of the Federal Reserve now, we might actually start feeling these effects much more quickly. And based on this piece by the Chicago Fed, they suggest that the majority of these lagged effects of monetary policy tightening have already occurred. And that policy, and they'll go through exactly what percent they think in just a moment, but it's about 75% that they think has already occurred, and there's some important implications for that. They think that the policy tightening that has been implemented will, however, continue to exert further restraint in the quarters ahead, amounting to downward pressure of 3 percentage points on the level of GDP and 2.5 percentage points on the level of CPI. Tightening effects on the labor market manifest more slowly, so more than half of the policy impact on total hours worked is yet to come. Now that's actually interesting because it feeds into the leftover part that the bears do talk about. The bears say, hey, look, it is actually the jobs market that is really where the pain can begin in this recession that we may be going into. And the reason people believe that is because recessions can really start for a few different reasons. They could begin from cyclical reasons. They could begin from industry reasons. But what this impact is potentially likely to be from, that is through this cycle, is from an I just want to make sure the mic is right. I thought the mic was on my AirPods for a moment. I'm like, as much as I like listening to myself on these things, I hate listening to myself, but they're functional for that. But, or if I have to put somebody, another interview on or something like that, but boy, oh boy, in terms of speaking through these things, the audio is crap. So anyway, so this type of recession, what people believe is that we would actually begin the recession by having pain in the jobs market. Pain in the jobs market would then lead to lower spend. Lower spend would then lead to lower earnings per share at companies and obviously less output, and then potentially thereby layoffs. And then you have this cycle of pain, right? Where you get pain in the jobs market, lower spend, pain at companies, more pain in the jobs market. And you basically have this self-fulfilling disaster. And the risky thing here about the Chicago letter is they say, look, we felt 75% of the tightening on GDP on CPI already, but only 25%, or sorry, only 50% of the pain on labor. Well, I guess they say technically here, so more than half of the policy yeah, I guess that's actually a little less than 50%. See, more than half of the impact on labor is yet to come. According to the model's forecast, the policy tightening that's already been done is sufficient to bring inflation back near the Fed's target by the middle of 2024 while avoiding a recession. Now, that's really interesting. They're basically saying, look, the Fed has to do no more, and we can avoid a recession as long as the Fed essentially stops hiking, because there is still a very large lag effect on labor. The effects on CPI and GDP are already functioning well. Now, let's jump to the end, and then we'll look at some of the charts here. So if we go to the end over here, we look at their conclusion. They suggest here that they rely on expectations of monetary policy. And so this is their argument, a little bit more of a forward-looking model. Expectations are pretty important. In fact, there's a strong argument that the entire reason the Federal Reserve is actually suggesting that there might be one more hike is because they're not trying to signal they're done. Here's the problem once they signal they're done. As soon as the Fed says, we're done, what do? You license locking in higher yields on the 10-year Treasury, or even the 20-year, right? The longer end of the curve. Once you license locking in the longer end of the curve, which is a fancy way of saying it, it's just basically saying 10, 20, 30-year bonds, right? Once you give people a license to buy those, in other words, hey, we've reached peak yields, go ahead and buy the long bonds. Something really incredible happens once you do that. Guess what happens? Once you let people buy these, then what ends up happening? Demand goes up for long bonds, like the longer term bonds, I should say, not being bullish bonds, but the longer term bonds. When demand goes up for the longer term bonds, what ends up happening? Yields fall on these longer term bonds, right? And what does that actually end up doing? It loosens financial conditions. So the problem with that is the Federal Reserve is trying to put pressure on markets by having higher yields, 10, 20, 30-year mortgage yields, which are mortgage rates, which tend to follow the 10-year Treasury. You need these yields higher so you could have this broader tightening of the economy. That's what the Fed wants. They want this tightening. As soon as you say the peak is in, you say to people, buy it. And you can now lock in these longer-term bonds without the risk that values of these bonds are going to continue to fall, which right now they kind of have continued to fall. I mean, consider what we've got on the 10-year. You had Bill Ackman short basically the 10s right around 4.2. We're at 4.27 right now in terms of yields, which actually means he's up because of the inverse relationship. We recently went we went down a little bit. We've been up a little bit. Been on this giant roller coaster here. I personally think they need to go down from here. That's why I'm along TMF, which might be a little early, but that's because I think we're within one hike of being done, which I think creates this interesting opportunity to maybe go long TMF, which is essentially a leveraged ETF for going long the long end of the Treasury curve, like the 10, 20, 30s. And as soon as the Fed does admit we're done, TMF should do very well. But we have to wait for that moment. So anyway, they're arguing that they use their policy here or their models to try to understand what's going on with expectations, a shift in policy making over time that puts more emphasis on the expected policy path, such as a heavier reliance on explicit forward guidance, may have made the expectations channel more important and thus shortened the apparent lags of transmission. This is important. And it's not to say that, like, oh, this time is different. But one thing that factually, because again, you could totally still be walking into a recession, right? It's worth knowing that. But one thing that is dramatically different in this cycle compared to the past Federal Reserve tightening cycles is that the Fed is much more, what is APMF? I see the comments, ATMF. It's just ticker TMF. Ticker TMF, just type that in, you'll learn more about it. Go read the prospectus. Anyway, so in past tightening cycles from the Federal Reserve, you didn't actually have this extremely clear guidance of what was to come in terms of, hey, we're going to hike until we believe that expectations are set to bring us back to an average of 2% inflation. And they're very clear. In fact, pretty much every single time they've hiked for the last, year and a half, they're like, we probably have to do more. Here's our estimate, but we probably have to do more. And some actually argue the fact that the Fed has told us so aggressively we have to do more is why the yield curve is so inverted. Now, people get mad at me when I say this. They're like, "Oh, Kevin, don't explain away the yield curve, okay? The yield curve's basically always right, especially when it's this inverted." That's true. When you just look at the yield curve in general, there has been, there have been, like, you look at 1998, you sort of had a false inversion. Now, people will say, like, oh, but that was, really close to the dot-com bubble, possibly. You look at 1994, you almost had an inversion. So there have been some cases where it's like, it's not 100% perfect in a very quick term. But yeah, otherwise, I mean, short of these little asterisks, let's just be very clear about it. Anytime you have an inversion that's this deep, you've had a recession. Okay, there's no mincing it here. You get a recession after you're this inverted. The one way that people try to explain this yield curve being this inverted, though, is I want you to think about this. And it's kind of a little bit of a wild thing to think about. But let's put it this way, okay? If somebody came to you and said, so if someone said, hey, yields are going up for the next 2 years, which is roughly what the Fed has been suggesting, is that it's going to take until 2025 to get rid of this inflation. If somebody said that, then you probably would have substantial risk in 2-year treasuries, right? In shorter term treasuries. Why would you buy a 2-year treasury? What's a 2-year treasury yielding right now? Let me see. 2-year treasury. The 2-year treasury right now is at 5%, 4997. Okay. Why would you buy a 2-year treasury? Watch this. 2-year treasury. What does that get you? 5% yield. You're like, oh, well, Kevin, of course, I'm going to buy that for a 5% yield. No, you don't buy the 2-year treasury for a 5-year yield. You know what you do for a 5-year yield? You get a money market, and then you get your 5% yield. Guess what? The money market, no risk of higher for longer, because it's basically cash. There's no risk of your bond losing value because the Fed's going up higher. So in other words, what happens? Less people buy the 2-year. Now, the 10-year is a little different. The 10-year plus is a little different. That's 20 or 30 year, right? Because you're like, look, I can get through the next 2 years and then have juiced returns on 10, 20, 30-year bonds for a long time. I mean, consider the 10-year right now is 4.27. That is, you buy it right now, you could get 4.27. For the next 10 freaking years. It's amazing. You look at the 20-year. This is just so wonky. You ready for the 20-year? 4.55% right now. And then let's look at the 30-year. 30-year. 30-year right now, that's the 30-year mortgage, 30-year treasury. Okay, 30-year right now, 4.36%. So again, point is, you want to lock in these higher yields for a very long term. You go buy the longer end of the curve, because eventually the Fed's going to cut rates. And when they cut rates, what happens? These long bonds become more valuable. So in other words, when cut, 10, 20, 30 become much more valuable, and then yields fall, right? But the 2-year, well, it might take 2 years to get those cuts. So you're not guaranteed with an asterisk, that capital appreciation. So what does that do? So more people buy the long bonds than the short bonds. Okay? Well, what does that cause? An inverted yield curve. Kind of crazy. So that's at least my thinking, because you have, again, more buying on the 10, 20, 30. What happens when more people buy the 10, 20, 30? Yield goes down. Price up, yield down. So the long bonds yielding less because they're more desirable for that long-term investment, that capital appreciation. You could get through the Fed's 2-year hiking cycle. Expectations are literally manipulating the yield curve in exactly the way you would expect. Like, ignore the potential for a recession for a moment. And I'm not saying, like, put your blinders on, oh, there won't be a recession. Just think for a moment. Let's just say like Jesus Christ came down and said, there will be no recession. Thank you, God, right? Okay. Why then would the yield curve be inverted? Well, because at the same time, basically, the econ Jesus Christ is coming down and going, buy the 10, 20, 30-year bonds. Don't buy the 2-year. Buy money markets instead. So, like, in simple English, that factor right there would literally give you the inverted yield curve, which is weird because people are like, but wait, the yield curve is supposed to say recession. But again, if Jesus Christ came down and said no recession, you would still have this inverted yield curve because of what I just described, which is kind of crazy because, a lot of people are, no, it's definitely signaling a recession. Yes, maybe it is. Maybe that the lagging pain in jobs is going to drive us into recession. It's entirely possible. Let's keep going, though, because they do talk about when they think inflation will be over. So, okay, here we go. Their latest data now about when inflation will come down. You ready for this? This is based on their survey. This is a good one, too. The survey's models suggest that the effects of past tightening on inflation have almost run their course. However, skipping the econ talk here, headline CPI inflation will fall below 2.3% in 2024. This 2.3% rate of CPI inflation historically translates to around 2% of inflation according to PCE, suggesting the FOMC's target would be approximately met by the middle of 2024. The abatement of inflation occurs, then, without a recession, as real GDP growth remains in positive territory throughout the projection, although the model does not forecast a significant slowdown in hours worked. As a result, the model predicts that 3-month T-bill rates should be unchanged for the rest of the year before gradually declining in 2024. This is that higher for longer thing where it's like that gradual decline, right? Unlike the counterfactual exercise shown in Figure 2, these forecasts do not isolate the effects of monetary policy. However, it is important to note that there are wide uncertainty bands around the forecast. Whatever. That's basically a fancy way of saying, look at our uncertainty bands. Okay, so this is where they're like, okay, is a recession possible? Yes, but look at where the uncertainty bands say it's possible. Basically the end to beginning of 2024. But that would only be that tiny little segment right there. So yeah, that chance is still there, but it seems like we should be at a positive real rate of 1 to 2% over the next 2 years. Yes, we know the Atlanta Fed now real GDP has us at like 5.6%, but we don't even need that. We just need to be below trend, which, if trend is like right there, 2.5% GDP, we just want to be below that. That's the Fed's goal. And then here's their projection for headline inflation, which suggests by the beginning of 2025, yes, maybe inflation could be as high as, say, 2.4%, or quite frankly, as low as, 1.1%, probably be right around 2%, is their projection. Look at some of the other bands right here. Cumulative effects on hours worked. You can see most of the pain for that jobs effect, and these are very small percentages, mind you. Most of that pain really expected to be over here, 24, 25. There's your lagged effect. You've got, some other charts you can kind of look at here. These are less important when I went through this the first time. But I did think this was interesting. Look at where they expect rates to actually start falling. You ready for this? It's basically November. That's where they think you hit your peak. And then from there, it's basically falling rates all of 2024. Guess what that's going to be really good for, falling rates in 2024? Okay, you ready for this? This is going to piss a lot of people off again. It's going to be really good for those cyclical interest rate sensitive sectors. Gee, I wonder what some of those might sound like. How about Tesla, Enphase, and some of the other delicious interest rate sensitive companies? Guess what companies that's bad for? How about those staples like Dollar General, Dollar Tree, Hershey's, Kellogg, Walgreens, Paramount, Pfizer? Oh, how interesting. All of those I just read off have hit new 52-week lows at some point today. How interesting. That's kind of what we were expecting would happen at the beginning of the year. Now, one I will be wrong about, I will say has not hit that damage yet, is quite frankly, and I'm a little I'm still pissed off about it because I think it's still coming, McDonald's. I think McDonald's is literally overvalued trash right now. Absolutely, literally overvalued trash. I'm sorry, okay? Look, I'm not here to give you licensed financial advice in this video. But I'm going to give you my real opinion here. You can even look at the earnings for it. I am here to tell you that this is brought to you by StreamYard. Go to metkevin.com/StreamYard or meetkevin.com/StreamYard. It doesn't really matter. And learn more about StreamYard. In fact, I think we're getting rid of the whole MetKevin. Too many people have been telling me, Kevin, saving the one letter is not worth it. Just stop with the MetKevin. It's confusing. Okay, all right. So we're going to do away with it. I just have to untrain myself for years of that now. So we're going to just go to meetkevin.com/StreamYard. I thought it was cool because people wanted shorter domains. And, the whole thing is it's a URL shortener, MetKevin shorter. And people are like, but I don't get it. You're Meet Kevin. I'm like, oh. Anyway, McDonald's is overpriced trash. I'm sorry. It's just my opinion. And I think their stock needs to come down substantially. I think that you're going to deal with, the one place you're going to deal with the real pain of the leftover effects of inflation are going to be the fact that you're starting to see at restaurants people finally start pulling back. One of the things the Beige Book told us yesterday is that people were starting to pull back on restaurant spend. That restaurant spend was flattening, and basically every kind of eating out was slowing down and flattening. And on top of this idea of restaurant spend flattening, you have higher food costs. You have wages that still are playing catch up, right? And now I don't think that actually ends up leading to any kind of, wage price spiral. That we've totally missed a wage price spiral in the cycle. But it does lead to pain for companies like McDonald's. But let's just look at McDonald's for a hot minute here, okay? So if I look at McDonald's for a hot minute, what I'm going to do is I'm going to look at the valuation of this company. It's probably going to piss me off. It's been a while since I've looked at it, but you know what? We should be real and go look at it for a moment. So what do we got here? So McDonald's is looking at generating $11.54 of EPS. The sucker's trading for $275.44 divided by $11.54. That puts you at a 23.86 peg, okay? 86 those patties, McDonald's. You guys are about to get screwed. It's just my take. I don't know. I could be wrong. But anyway, that means for McDonald's, 23.86. Okay, and we're going to save that. And what we're going to do is we're going to look at the growth rate. That's for the end of this year. Growth rate going forward, 7.8, 8.6, 10.3, 12.5. I think it'll be less, but whatever. That puts you at 39.2 as growth over the next 4 years, divided by 4. 9.8%. Average growth expected, compounded annual for the next 4 years. Okay, 23.86 divided by 9.8. That's putting me at 2.4 peg. Paying a 2.4 peg for McDonald's. Why? It's because it's seen as an inflationary safety play. People still see it as a play that suggests, well, if inflation's high, people are going to not be able to buy miso salmon at Cheesecake, and they're going to have to forego on the beautiful sweet brown bread, which is just molasses dyed white bread, and they're gonna end up having to suffer McDonald's. So it's some institutional hedge, okay? This is in contrast to a company that actually grows. And that's going to be a company like Tesla, which Wall Street expects to grow somewhere around, 29% per year. I think that estimate, quite frankly, is on the low side, but whatever. It's in contrast to a company like this, or a company like an Enphase, which is basically selling in like value world. I mean, you really want a true comparison. You want to know the cheap ones right now? The cheap ones right now, on a PEG ratio basis, that are actually growing companies that matter, that aren't just inflation hedges, that are companies that benefit from interest rates going down. The list of the cheapest ones, simple. Okay, so I'm going to sort this. I have a thing called the K-PEG. It's basically the Kevin's adjusted growth rate and then the PEG. We talk about it in the course member live streams. Anyway, the cheap ones, Enphase, Ubiquity, TSM, all of them under 1 with a K-PEG. Actually, mostly right around 1 with a regular PEG ratio as well. Etsy, PayPal, ERJ, AMD, surprisingly actually, NVIDIA, Meta, Disney, although Disney you have to be careful about, all of those under 1.5. Tesla's like a 2, but that's also being generous with, I should say conservative with the growth, 30 to 35%. But McDonald's? It's just a rip-off, man. Anyway, so I think it'll suffer just like the rest of these suckers that we've expected, that the staples will end up suffering. Again, the reason people are in the staples is because they see these suckers as an inflation hedge, and the days are numbered. Again, they have done well. Here's the chart of McDonald's. They've done very, very well. It's very upsetting to me because it means I was wrong. But I'll be right eventually. So, anywho, Starbucks. That's a really good question. So, the thing about Starbucks is I find that they're expensive, over $80. They're at $95. I've actually personally been waiting for Starbucks to come into the $80 price range. But the reason I was excited about Starbucks going into the $80 price range was because I thought I would be able to pick up a good deal on Starbucks around $80 and then have cheap exposure to China, because Starbucks covertly doubled their restaurants, their stores, right? Their coffee shops in China during the pandemic. Nobody paid attention to this, and they just overnight, it feels like, doubled their stores in China. Problem is now China's basically in the dumps. So, that is now less desirable, even less desirable, which is not great because it's kind of like, wait a minute, crap. That's what you wanted. Chipotle, I will say, they have managed to really hold up. I think I'm not going to invest in them because I still think you have some, a staple exposure here, but they have the growth. They really have the growth. You look at their growth rate, you are projecting a growth rate at this company of 21.6% over the next few years, which is really, really incredible. If I take their EPS, 1954, let's see here, 1954 projected Wall Street EPS. Oh, my numlock turned off. What is going on? Kevin. There we go. 1954, 12 divided by 43.38. Divided by 21, but you had 2.1. So still a little up there. I'm okay up to a 2. I think things get sticky. Apple ran up to a 3 for a while there, and I think they're actually still around 2.8. It's too expensive. That's why I had to reduce my exposure to Apple. It just got way too once these pegs get too high, I'm like, yeah, no thanks. Paying way too much money for growth. But then I also have to figure out what industry they're in and what potential for more growth there is after that. So anyway, thanks so much for watching this segment. Check out StreamYard by going to metkevin.com/StreamYard, and we'll see you the next one.
Why not advertise these things that you told us here? I feel like nobody else knows about this.
We'll try a little advertising and see how it goes.
Congratulations, man. You have done so much. People love you. People look up to you.
Kevin Paffrath there, financial analyst and YouTuber. Meet Kevin. Always great to get your take.